New Zealand dollar Swiss. I've got moving averages on here. The black is the 50, the blue is the 100, the green is the 500, the red is the 200. So New Zealand dollar Swiss. I need to go to the weekly chart to start with. I need to see what trends have we got. We are definitely in a bear trend for the New Zealand dollar versus the Swiss franc. So on the weekly chart, that's all I need to know right now. We're trading around the lows. We've broken the previous swing low from 2020, March 2020. So I certainly wouldn't particularly want to be long this. I wouldn't want to be trading against the trend. Almost a bullish engulfing candle here, because I don't think the body of the candle is above the previous candle high, but a relatively bullish candle. So that has triggered something of a correction to the upside, short covering perhaps, but that in itself doesn't give me any indication that I should be long. I want to be selling into strength. Now I'm going to put some Fibonacci levels on here. Where can I put them? I need to go back to my weekly chart to put the Fibonacci levels on. Okay, I'm going to take this swing high here. You can see that that is a major swing high. We had this big move up and then we collapsed from here. So for me, that's where I'm going to take my Fibonacci levels. And I'm taking them in order to find a really good sell entry point for myself. So Fibonacci levels are here. Okay, here we go. Right. There. That's now the focus of my attention on the weekly chart. I want to put a secondary set of fib levels on there. I want to break it down, and I'm going to take this swing high here. So Fibonacci. Now I'm going to go to the daily chart. I'm looking for a sell level. I'm going to put some trend lines on. That looks like a beauty. I've just joined this low and this low, and look how nicely it's intersected with this. We broke below the trend line, retested it and collapsed. So I really like this trend line, but we're nowhere near a sell level at the moment. I'm going to take a second set of fibs now from here. I know this is getting a little bit confusing, but bear with me. I like to break my charts down with more Fibonacci levels. There is a 61.8% Fibonacci level here from the second set of fibs that I drew. I'm going to take this swing high from around that 61.8% fib, and I'm going to drop it down here to the swing low again, because I just like to put subsets of fib levels on. Okay, so now I'm getting a 23.6% fib for this New Zealand dollar Swiss at around 93. What can I say about that? That matches this little swing low up here. As you can see, that's probably it's not the greatest trade opportunity. I would want to get into a sell position here because I think this is a bounce in a bear trend. There's only one thing that is concerning me. Is this a double bottom? I could argue that this is a double bottom pattern, but it's not until we break above the neckline here, which is around 55.00. That's 250 pips away. So right now, my focus is going to be with getting into a short position in the expectation that this is actually a bear flag that we're seeing here on this bounce. If we start breaking above 50, then that would be significant because we would have broken the 200-day moving average, the red line. We'd have broken my confluence of fib levels, which is, as you can see here, and we'd have broken this swing high. Right now, my focus would be on being short this market. On the weekly chart, I've tried to isolate the most recent down move. So it's very clear that after this correction higher, this is now the main move to the downside that we're in. That started in February of 2021. So that is a 2.5-year-old. Normally, I would like to see a swing high around the 61.8% fib, and you often get it. This unfortunately didn't quite make it. And you can see why it got to here, because we had this big move to the downside and then a bounce. And then once we broke this low, you can see that that became resistance. That's quite normal. There's my horizontal line. There we go. Then you can see why that became resistance. For me, if I had had a swing high at the 61.8% fib, I would have put another set of fibs on. But as that didn't work, what I then tried to do is isolate the next move down in this trend. So we collapsed, we had a really good bounce, and then the market dumped. So I've taken this swing high here and then isolated this move to put my Fibonacci levels on so they can become a bit more relevant. And then again, why did I take that one here? I can't remember now. Let me go to the daily chart. Oh yeah, then on the daily chart, with my second set of fibs that I took, which was here, isolating that last move down, I have a 61.8% fib here. And that is why I've taken this point here. Again, a big move to the downside, then a decent correction higher, and then another big move to the downside started. So that's why I've taken my second set of fibs from this peak here. And now this then I'm looking to see, do my fibs tie in nicely with the price action? Yes, I'd say they do. Certainly we've got a confluence of fibs here, 38.2% and a 61.8, bang on that swing high. That's going to be a beautiful resistance level if we ever get there, because the 200-day moving average is also going to be adding to the weight of that resistance. I've got enough fibs on there now, and this 23.6% fib comes in around 292, not far off the 50-day moving average, which is around 53.12. So within that 20 pip band, that should be a good resistance level. So I personally wouldn't be getting in right now. I'm not saying the market won't turn around from here, it might do, but I think we're going to ease this oversold condition on the slow stochastic a little bit more. And if we do, and we can get up to there, that would be worth trying a short position. Now you could get in around there. Let's say we're getting in around 53.00 just to make the maths easy. We could have a stop loss of 53, so we'd have a 25 pip stop. And then obviously if the trade does well, we could be around 51.90. We could easily have 100 pip target on that. So that again would be a 4-to-1 risk reward ratio. That would be a really nice trade. Trading in the direction of the trend, waiting for a resistance level, tight stop. If we break up, then we've got another resistance level here around 53.65, 53.75. We've got the fib levels, we've got the 100-day moving average. So that's how I break my chart down. By then, another thing to note, I don't trade on these oscillators very much. They're not something I pay too much attention to, but it is worth noting that this can help with trend identification. So for example, that we're in a bear trend. Look, you can see that. See how we don't spend much time in overbought territory. As soon as we get overbought, we turn around. Look at all these points here. So this one spent a little bit longer, but it's a nice rounding top. Now, but when you're in a bear trend, you tend to spend a lot more time in oversold territory. This is actually a little bull trend here. When I say a little one, it's from October up to December, a 2-month bull trend. Now here you can see that we spent a lot of time in overbought territory when the market was trending higher. But as soon as that trend changed from here, then we started spending, the turn was almost immediate on the slow stochastic or on the RSI, whichever one you choose to follow. And then we tend to spend more time in oversold territory. So this is just something that is worth looking at. When we're in a bear trend, we will turn quite quickly when we get overbought. We may not even reach the overbought level. We didn't there. But then, we'll get oversold quite quickly, and we'll stay oversold because, of course, we're in a bear trend. So the market price will continue to trend down. Here, as we're really getting into the depths of a bear trend, you can see we spent a long time being oversold. This bit down here is my slow stochastic. Spent time studying RSIs and Ds and all those kind of oscillators, and I don't really believe in them. The problem is with oscillators, they're too easy to rely on because they're so visual. It's too easy to say, oh, we've got overbought, I'm going to sell it. We've got oversold, I'm going to buy it. They don't give you any idea of timing. I wouldn't base a trade solely on these. Now, let's pretend that we are here. We know we're in a bear trend. The market's had a good bounce. Look at that bullish engulfing candle, indicating 2 bullish engulfing candles. That was the clue that the market was going to bounce. Another one here, in fact. So those indicated that the market was going to bounce. Now, we didn't know how far it was going to bounce, but we went straight to this confluence of Fibonacci levels, and then the market reversed. If we were selling in at that Fibonacci levels, that would have worked well. The market had got overbought in a bear trend as well. So you're thinking to yourself, this is probably a trade that's worth doing. We've had a really good bounce. We've hit a resistance level. We've got overbought on the daily chart. So that's my breakdown of the New Zealand dollar versus the Swiss franc.